Now, Friday's trade seems to suggest that most concerns, will we have a soft landing in the US, are we looking at any kind of recession, seem to be behind us. From an India perspective, foreign flows look poised to re-enter. So what really should be the outlook? Are we now set for 26,000? Quite firmly on the Nifty, and what next? Joining me to talk on this is Mahesh Patil, CIO of Aditya Birla Sun Life AMC. Mr. Patil, a very good morning to you, and a great time to have this conversation on what seems to be like a good day. Let me just come to you, and I know you would probably say that it's just a number, but the distance to 26,000 seems like an exciting one, isn't it? I think you're on mute, Mahesh.
Yeah, sorry for that.
There we go. Yeah.
I think markets again this year looks to be a good year. I think clocking in year till date, right? And it's been rising again to some extent, driven by domestically. I think the growth momentum continues to be fairly decent and strong. GDP numbers have been strong. We've seen that the much awaited rate cut in the US is also now kind of started. And more importantly, I think the liquidity, right? The money flow into the market continues to be robust from domestic investors. So that is keeping the markets really up. But also now, I think post the rate cut, and I think with dollar likely to weaken from here, we could also see emerging market flows of flows into India, okay, which have been kind of tepid, okay, for the last year or so, could also tend to reverse a bit. So I think the direction of the market looks to be fairly on the uptrend, though I would say that clearly the market, while it would continue to probably move up, okay, but we would probably see some more volatility coming in down the line, because you have elections in the US, okay, the outcomes there could lead to some volatility on the global front. So that is something which I think one needs to keep in mind. But I think one interesting thing what we're seeing is that while the Nifty and the other headline indices are making new highs, the breadth of the market is now slowly starting to weaken. So what I mean by that is that if you look at the number of stocks which are down, say around 20%, 30% from their peaks, okay, in this year, I think the number of those percentage of stocks is now kind of increasing. So I think that's a slight change from what the market was doing, say, until, say, the beginning of this calendar year. But otherwise, I think earnings momentum is definitely slowing down. So I think that should slow down the pace of acceleration in the market is what I would think.
Okay. No, just to come to some of the factors that you mentioned, Mahesh, and I think US elections, rightly so, is the next big thing globally to look out. At least the latest polls, and you know these things change, but at least the latest polls seem to point towards a Harris administration next. What does that mean for US markets and from an Indian perspective? I'm not talking about the politics of it at all, but from an Indian perspective, does that make a big difference to us and to the US markets?
Yeah, I think so. In a way, from a US market standpoint, I think it would be probably continuation of the existing rule of the Democrats, right? So the policy of the earlier this regime would continue. So I don't think that should lead to any large volatility over there. Obviously, the stimulus would be to in terms of how do you prime the US economy and ensure that there is a soft landing. And I think some of the measures, okay, which the Democrats and Kamala Harris has talked about in terms of generating employment, I think that should be positive. I would say that in that context, I think the volatility in the US market could be much lower, okay, if that is the outcome what we are looking at. And even from an India perspective also, I think I would say that it should be fairly normal. I don't see any reason, because Trump would have mean that there would be more tariff barriers. Okay, at least the rhetoric there could have been slightly negative for India.
Okay. In terms of India right now, do you think, Mahesh, that we will see those global flows coming in? I mean, the numbers for Friday were astonishing. Some say it's because of the FTSE rejig, and a lot of them are passive flows. I don't know what your take is on that, but do you see that sort of floodgate opening now?
It's not like, I mean, we're not going to see the floodgates opening and big money coming in. But if you look at 2-3 data points, it suggests that probably you should see the reversal, okay, of the outflow what we have seen in the better part of this calendar year. So, one is the rate cuts means that you will see that US dollar starting to weaken, and that's been now kind of quite apparent. Okay, that would mean that more money into emerging markets, and India should get its share over there. Also, point to note is that India's weightage in the now emerging market index or even the global index is at an all-time high. It's now overtaken China also, right, which used to be around close to around 22%. And relatively, if you look at the global funds, I mean, all the emerging market funds, fund managers globally are now slightly underweight India. I mean, historically, they have been overweight India, and the overweight has been as high as around 3 to 4%, right? That has now gone to marginal underweight. So I don't think there is room for FIs or the foreign investors to really go underweight in India beyond this point, because India is a relatively better performing market, right? So in that scenario now, I think I would say that you should see the flow starting to improve. Obviously, India is relatively expensive vis-a-vis the region, and that could always be a debate, and that is what has kept foreigners away. But I think there won't be much choice, because India remains a good long-term growth market, and foreigners would want to participate in that. So I would say that you should see at least the FII flows starting to turn positive. Though I would not likely to say that you would see a large number coming in, because unless there is a correction and some moderation valuations where you could then see more money coming in big quantum from the foreigners.
And will that be coming into banks? I'm wondering how right now, Mahesh, you're feeling about banks, private banks. I know you'll not tell me about HDFC specifically, fair enough. But, I'm wondering if you're feeling some of that concern which we were seeing at the end of the last quarter numbers on deposit growth, etc., ebbing?
So on the banks, I mean, one is on the technical side. If you look at it, that there have been huge sell down by FIs in the banks. So when they were selling, the bulk of the hit was taken by the banking sector, because that's where the larger ownership was, especially some of the larger banks. Okay, where FIs held a larger chunk, and that's why now I think the after the last selling, I think clearly the positioning in the banks from the foreigners seems to be much lighter, and banks continue to be a large liquid name, right? So whenever money flow starts to revert, I think that's the sector which could probably attract some of that flows. Also, banks, if you look at the private banks in general, they have underperformed, right, in the last 1 year or so. And the valuations there are more reasonable if you compare that with the long-term averages, right? So clearly there the risk reward looks more favorable, and you could see more money chasing that, and that could possibly be a rotation back into the banks, and you could see a relative outperformance over there going forward. So I think that could be a reason why I think you could see banks potentially doing well. However, the headwinds from the banks in terms of the deposit growth, I think that still remains, right? Okay, that is still a challenge, and that's the reason why there have been downgrades to the credit growth for the banking sector in this fiscal year to now around 12-13% compared to around 14-15% earlier. But so I think that, but I think the overall system liquidity, if you look at RBI liquidity, is now starting to improve. So that should give some relief in terms of garnering deposits. But clearly that remains the biggest challenge at this point in time for the banking system.
Just last point from you, Mahesh. We spoke a bit about banks, but in terms of the sector rotation that we've been seeing in the markets right now, what is looking most exciting to you? What are you most constructive on? And will rate sensitives like autos and realty make that list?
So yeah, I think in a way I would say that there are a couple of things which we are positive on. One is consumer discretionary side, because that is more likely to be influenced by any rate cuts. Okay, we see a lot of now consumer discretion buying happens based on leverage, okay, or loans, and that any increase in cut in interest rates in India, probably 6 months down the line, could mean that you would see more disposable income at the hands of the consumer. And this is a sector which had underperformed last year. It's only starting to pick up now in the last 3 to 6 months. So structurally, we think that's a sector which can do well from here. Also, the rural economy is, again, there are some green shoots there about it picking up. Rural wages are slowly, the real wages are starting to improve. And the monsoons have been fairly okay, so you should see that picking up. So I think second half, I think rural demand could pick up, and that could also drive demand for some of the rural plays. So these are some of the themes which one can look at from a medium-term perspective.
Okay, thank you so much, Mahesh Patil there, talking about what the themes are, and definitely consumption is one of them. I mean, we talked earlier today about a CLSA note which managed to quantify all the angst and excitement about Coldplay tickets into a stock idea, which in their view was Zomato. So, you know, that theme definitely will continue.